everybody, and happy Friday. My name is Colin Evans, and I'm part of the business development team here at Baird. On behalf of your Baird advisors, I want to thank you for joining us for today's Baird Wealth Strategies seminar entitled Year-End Planning 2025 and Looking Ahead to 2026. Whether you want to optimize your tax strategy, explore smart investment decisions, or set yourself up for a strong start to 2026, this session will equip you with actionable tips and expert guidance you need to know heading into the year end. But first, let's introduce you to our two esteemed speakers. First up, we have Kelsey Clare, who is a senior tax strategist for Baird's Private Wealth Management Group, where she identifies strategic planning opportunities and provides insights on tax issues affecting clients. She joined Baird in 2020 after working at Dixon Hughes Goodman, now known as Forvis, delivering tax compliance and tax planning services to high net worth individuals and privately held businesses. Kelsey holds both a bachelor's and master's degrees in accountancy with a focus on taxation from the University of South Carolina. She's a certified CPA and holds the Certified Private Wealth Advisor designation. Next up, we have Eric Wickstrom. He joined Robert W. Baird & Company in 2021 as a tax strategist for the Baird Private Wealth Management sector. Prior to joining Baird, he operated his own tax planning firm specializing in alternative retirement plan investments. Throughout his career in tax, investment, and corporate finance capacities, Eric has helped develop and structure sophisticated financial solutions to meet the unique goals of individuals and institutions. He graduated from the University of Washington with a Bachelor of Arts degree in business admin, and also holds a Master of Science in taxation from Golden Gate University in San Francisco. He also holds the CPA, CPWA, and CFP designations, as well as a life insurance and disability license in the state of Washington. These two strategists are part of our broader wealth planning team, who are regionally aligned to assist our advisors in delivering the best advice through quality, holistic financial planning engagements. But before I turn the call over to Kelsey and Eric, I have a few housekeeping items I'd like to highlight. All participants are currently in a listen-only mode, but we'd love to hear from you. We will host a Q&A session at the end of the call to address as many questions as time permits. You can submit a question by clicking the Q&A icon. Please be sure to address your question to all panelists. This presentation is being recorded and will be available along with the slide deck through your Baird financial advisor about a week following today's call. And with that, I'm going to go ahead and turn it over to Mr. Wickstrom.
Thank you, Colin. Appreciate it. My name is Eric Wickstrom, and we're going to go through some updates for 2025 and appreciate your time. And excuse me, let me get back to where I was. There we go. So everyone pays tax in one of two ways. We have ordinary income and we have capital gain income. And we're looking at a married filing joint bracket that's been updated for 2025. And we know our brackets now as of the new latest tax bill that was signed July 4th. And I know there's a lot of numbers here, but just recognize your taxable income can be broken out into ordinary income on the left and capital gain on the right. And the other thing to note here is these brackets have different widths, but we calculate your ordinary income first, and that last dollar of ordinary income is where our capital gain taxation starts. So unfortunately, you don't get capital gains always at $0, but we take ordinary income and then go look at capital gain income. And this is the married filing joint bracket. And you see it's very similar to the single bracket, which we're looking at now. It's just that the single amounts up to about 35% are literally about half what married filing joint is. And that's something to be aware of if your filing status changes from married filing joint to single, because all of a sudden you could find yourself with ballpark the same amount of income, but paying a lot more in tax because you're paying it at single brackets. So just keep in mind, all 5 of the filing statuses have their own brackets. And just we spend a lot of time helping people where they land in the ordinary and capital gain brackets. If you ever want to have that discussion, please reach out to your advisor and we're happy to talk to you about that. All right. The standard deduction, basically your tax return is done in sections. The top section is where we get all your income, and that comes to a subtotal called total income. You may or may not have a couple minor adjustments to get you to adjusted gross income. But at that point, everybody gets the greater of 4 individual deductions known as itemized deductions or a standard deduction. And the standard deduction was increased quite a bit in 2018 with a tax bill that was enacted then. And so a lot of people, and you may remember, keeping track of all your expenses for all kinds of things that were deductible. They've cleaned up a lot of that. And a lot of people don't itemize deductions anymore, primarily because the standard deductions have been increased so much. So you can see just on one of the filing statuses, married filing joint, for example, how the IRS fortunately increases the standard deduction amounts for inflation every year. So we know this year the married filing joint standard deduction, which everybody would get at a minimum, is 31.5. Next year it's going to go to 32.2. And off to the right, if you're 65 and over or legally blind, you can get an extra deduction amount depending upon whether you're married or single. So just keep in mind, everybody gets the greater of 4 individual deductions: medical, state and local tax, interest and charity, or the standard deduction for your filing status. All right, what are the new contribution limits for 2025? Well, traditional and Roth IRAs, everybody can contribute up to a maximum of $7,000. There's a lovely catch up if you're age 50 of another $1,000. The thing to keep in mind for any of these retirement plans is you have to have earned income, meaning you have to have W-2 income or self-employed income. Basically, you have to have income from providing services effectively. And so you can't just rely on interest income, rental income, dividend income. So you have to have earned income. They've taken the age limitations away from most all these. So if you're working in your 70s, you can still contribute to these retirement accounts. Traditional and a Roth SEP IRA, the limit's 70,000. You'll see that with self-employed people who have a simplified employee pension. A simple IRA is another type of small business retirement plan, and it has contributions ranging from 16.5 with some extra age catch-ups there. 401k plans and 403b, which are very well known and common. This year, the regular contribution is 23.5. If you're over 50, you can throw another 7,500 in that. And for a couple years, from 60 to 63, you'll be able to contribute an extra 37.50. So these are contribution limits that get adjusted every year. You have to have earned income, but if you're still interested in making a contribution, let us know and we'll figure out where you can fit on these scales and what types of plans you'd be eligible for. Okay, what are some other 2025 inflation adjustments we need to be aware of? One of the first ones is if you're at least 70 and a half and you want to contribute to charities and you're a standard deduction person, meaning you don't itemize and get a tax benefit for charity, we recommend you consider maybe making some of your contribution from an IRA account. Again, you have to be 70 and a half to do that, but you can contribute up to 108,000, deduct or give away, 108,000 from an IRA account. The good thing about that is that amount that comes out of your IRA, which ordinarily would be ordinary income, taxed at ordinary income rates, it doesn't show up on your 1040 at all. So qualified charitable distributions can be a good thing to give money to charities out of your IRA. I'm a big fan of health savings accounts. There's family limits and there's single limits. You must have a high deductible health plan. So if you're in a health plan with your employer or on the network, Obamacare network of plans, make sure you have a high deductible health plan. Check that first. Also, if you are on Medicare, you can't contribute anymore to a health savings account. So if you're before that age, you might want to consider making contributions to a health savings account. Again, you have to be in a high deductible health plan, but the money is tax deductible. You don't have to have earned income, and the money you take out of the plan, hopefully down the road, the health savings account, if you didn't need it all in any year, hopefully it's grown. And as long as you used it for qualified medical expenses, it's not taxable. So health savings accounts are great opportunities to get a tax deduction and save for future medical. This year, on the estate planning side, the annual gift tax exclusion is $19,000. You could probably remember when that used to be $10,000, then it went to 12 and 15. Well, now it's $19,000. That's per person. So in theory, you could give $19,000 to 10 different people. If you give $50,000 to one, you'd have a $31,000 taxable gift. You'd have to fill out a form, and you would just use up $31,000 of your lifetime gift in estate tax exemption. So speaking of that, during your lifetime, you could give away this year 13.99 million. If you did that during your life, when you passed away, you would have chewed up all your estate tax exemption. So what you use during your life gets subtracted from your estate tax exemption when you pass. So next year it's supposed to go up to 15 million. And so we have some good interaction with people in states that have fairly high estate tax limits in taxation, like my state of Washington, but don't have gift tax. So if you have any questions on that, reach out to your advisor and let's have a discussion. Okay, we're going to talk about a few things in the most recent tax bill that got a lot of notoriety in the spring and summer that was passed on July 4th, and it was known as the One Big Beautiful Bill Act, otherwise known as OBBBA. Just want to point out a couple things of interest to a lot of people. They came up with a new concept called the enhanced senior deduction. And if you're 65 and over during this tax year, 2025, you're eligible for a $6,000 deduction for each taxpayer. So if you're a single filer, that's $6,000 for you. If you're married filing joint, that's potentially $12,000, right? But like a lot of things Congress does, they advertise some things, but then they put a little hook in there. And the hook here is that there's potential phase outs, which just means reductions of that $6,000 amount per person if you're over certain adjusted gross income amounts. And so you see for joint filers, there's a phase out range that goes from 150 to 250. And for single filers and everybody else, it's 75 grand to 175. So we do a lot of tax projections with people, and we explain to them that the $6,000 that they thought they would have gotten, unfortunately, they're not eligible for because their modified adjusted gross income, if you're joint, looks to be over 250. But just know that this is a new deduction. You may be eligible for it. But if you're in those phase out ranges for your modified adjusted gross income, that 6,000 will start to be getting trimmed. So you may not get all 6,000. If you're over those amounts, you won't get any. This new senior deduction is available from 2025 to 2028, and it is in addition to the greater of your standard deduction or itemized. So you don't lose anything here. If you qualify and get some amount, that's added to the standard deduction or itemized. The other big item of interest for this year was the state and local tax cap. You may remember, and again, this only applies after adjusted gross income. You get the greater of the standard or itemized. If you take the itemized, and of those four, this is one of them, state and local tax, this is of interest to you. If you're a standard deduction person, this really doesn't matter. But of the four itemized deductions in 2018, that tax bill limited your state and local tax to a maximum deduction of $10,000. So we see a lot of people that had $32,000 of state and local tax on their Schedule A, but everybody was limited to 10. So Congress decided to increase that amount to a maximum of $40,000. Unfortunately, they put some phase outs in there, and you can see the phase out goes from 500 to 600,000 of modified adjusted gross income. So if you had, in our example there, if you had 20,000 of state and local, if you had 32,000 of state and local tax, but you were between 500 and 600,000, you would get some of that 32,000, but it'd start to get clipped. At a minimum, you'd get 10,000. If you're married filing separate, the cap is 20,000 and the floor is 5. So just keep in mind the state and local tax sounds great, but you may be limited in how much of that you can get as well. And that applies from 2025 to 29. One more deduction we want you to know about, or two actually, the reduced tax benefit for itemized deductions. This only applies to the table or the section on the left. If you have itemized deductions and you are a 37% ordinary income bracket taxpayer, they're only going to give you benefit for those itemized deductions up to 35%. So again, you might be a very high ordinary income taxpayer, and if you had itemized deductions, you got the benefit of those at your ordinary bracket, which was 37%. Well, next year, starting in 2026, not this year, but next year, if you're a 37% ordinary income taxpayer and you itemize, you're only going to get the benefit of those itemized deductions at 35%. Now on the right there, they also are putting in for 2026 a floor on charitable contributions. That doesn't happen this year, it happens next year. So you might want to consider moving some of the 2026 gifts you were mentally thinking about. You may want to consider moving those into 2025 because the charitable deduction floor is going to be 0.5% of your adjusted gross income. So in our little example, if you had adjusted gross income of $100,000 and you gave away $2,500, well, the 0.5% floor of $100,000 would be $500, meaning your $2,500 of charitable contributions would get reduced by the $500 floor, and you'd only get a net deduction of $2,000. So keep in mind here, we've got a little bit of time in November and December. Your contributions have to fall in the calendar year. So you can't make a contribution in January or February and allocate it to 2025. But just know that next year, there's going to be a slight reduction for charitable contribution people who itemize. And there's one more they added in the charitable. Congress realized that people who don't itemize really are locked out from making charitable deductions show up on their 1040. So they said, you know what, let's fix that to a certain extent. So next year in 2026, if you are a non-itemizer, you will be able to get a maximum deduction of $2,000 if you're joint filer, $1,000 for other filers. You have to make the deduction in cash. You can't give it to a donor advised fund. There's no income thresholds or phase outs, but the limits are fairly small. So if you gave $5,000 to charity, the most you could be able to deduct would be $2,000. So you may want to consider moving some of your small gifts that you're not going to get a deduction for this year into 2026. All right, with that said, I'm going to turn this back over to my colleague, Kelsey, who's going to go through planning strategies.
Awesome. Thank you. Thanks, Eric. So now that Eric's kind of touched on a lot of the inflation adjustments that we're seeing for 2025, also touched on some of the new tax law changes that have come about in OBA, I'm going to talk about some of the planning strategies we can consider in light of these changes. So first off, I want to just kind of give you guys a visual of what these new provisions could mean from a tax standpoint. Now, it used to be a little bit easier to quantify what the tax impact of something was. You could usually kind of look at your marginal tax bracket, say, okay, I'm generating some additional ordinary income. This is what the tax impact is going to be. There's always been some nuances there, but with the new bill, there is even more deductions coming into play, more credits, more phase outs coming into play that make that conversation or that decision a little bit trickier. So this kind of gives you a visual of that. You can see that, we didn't touch on all the provisions that are listed on this slide here, but for a couple filing jointly, we can see that they've got, the new tip deduction phase out, overtime deduction phase out. We have that $6,000 senior deduction that phases out at $150 to $250. The auto loan interest deduction, so that's new as well. That comes into play. We have our IRA deduction phase out our Roth contribution phase out, so whether or not you can contribute to a Roth based on your income level. The new SALT deduction phase out, so going from 10 to 40. And then we've got our 3.8% net investment income tax that applies to income above 250,000. We have our child tax credit for those with qualifying dependents. That phases out at about 400. And then we've got on top of that all the IRMA thresholds. So as you probably know, Medicare premiums have a 2-year look back. So they look at your tax return from 2 years prior to determine what any additional premium amount you might pay is. So this just kind of gives you a visual of all the different moving parts that come into play in your tax situation. And so while when you are making certain decisions about generating transactions, generating additional income, you want to be cognizant that it isn't necessarily a straightforward answer. So I want to kind of illustrate a little bit the new SALT deduction phase out. So like Eric mentioned, this went from a $10,000 to a potential $40,000 deduction, assuming you do have state and local taxes amounting to that. So let's look at a married couple with $500,000 of AGI. Let's assume it's all ordinary income. In scenario one, this is our first situation. So let's say they have income of 500,000, so they haven't entered into the full phase out yet. They are eligible for the full 40,000 in state and local tax deduction. Let's say they also have 30,000, let's say, in charitable contributions. So that gives them $70,000 of itemized deductions, bringing their taxable income down to $430,000. The tax on that is a little under $92,000. Now let's assume that couple decides to do a $100,000 Roth conversion. So that's $100,000 of additional ordinary income. Now remember that SALT phase out starts at 500, but it's fully phased out at 600,000. So that additional $100,000 caused this couple to lose out on that additional $30,000 deduction. So they're going to claim a $10,000 state and local tax deduction. They still have their $30,000 charitable contribution, so they have a total itemized deduction of $40,000. That brings the taxable income to $560,000. So we can see $100,000 of ordinary income is actually generating another $130,000 of taxable income. So the tax on that 560 is $135,000. So even though it's only $100,000 of ordinary income, we're generating an additional $43,000 of tax. So over a 43% marginal tax cost on that conversion. So, this is not the case for every single individual. This doesn't mean if you do 100,000 conversion, you're going to pay 43% on that. But I'm just showcasing that if you are in a certain situation where you fall in this phase out range and you generate additional income, the tax impact could be much more substantial than you might think. So with the SALT deduction, it is based on MAGI, or modified adjusted gross income. Unless you've got foreign income, it's probably just going to be your adjusted gross income, which you can find on your tax return. With adjusted gross income, though, you're pretty limited in terms of how you can lower that number. You can't lower it with itemized deductions or the $6,000 deduction, senior deduction. You have to utilize other methods that lower that top number on your return. So that's going to be qualified charitable distributions is one option if you're age 70 and a half. Tax loss harvesting. So if you have some capital gains, realizing some losses to offset those. Maximizing your retirement plan or HSA contributions, and then just deferring income is another methodology. Just trying to keep that top AGI number as low as possible. Now, when it comes to your charitable giving goals, we do want to consider the timing of those charitable contributions. So with the new benefit that is coming into play in 2026 that Eric mentioned, we say that for smaller donors, those that are not itemizing the return, they might want to defer their gifting into 2026. And that's to take advantage of that new $2,000 deduction for cash contributions made to public charities. That's the joint threshold. $2,000 is the limit for joint filers, $1,000 for all of it. all other filers. Now, for high income individuals or those in the top tax bracket, they might want to accelerate their gifting from 2026 into 2025. And that's because of those two new provisions Eric mentioned. So the 35% tax benefit cap on those deductions beginning in 2026, as well as the 0.5% AGI floor on charitable contributions. Again, that does begin in 2026. So for those types of taxpayers that, high income earners, highest tax bracket, they might want to accelerate their gifting. And I think this can be best described by looking at a scenario. So let's assume we have a married couple, their AGI is $1 million, and they give $100,000 to charity every single year. So on the left-hand side, this is our kind of base case, 100,000 charity each year. We can see in 2025, they're going to claim 10,000 in state and local tax deduction. That's because their income is too high to get the higher amount, the 40,000. So they get the 10. They'll claim $100,000 charitable contribution deduction, so total of 110 in 2025. And the tax benefit on that, being at the 37% bracket, is $40,700. Now in 2026, they do the same thing, but there's two new provisions that come into play. We've got that 0.5% AGI floor. So of that $100,000 charitable contribution, only $95,000 is deductible. And then on the total benefit of $105,000, the value of that benefit is capped at 35%. So it is actually only $36,750 for 2026. So we can see all in their tax benefit under this scenario is $77,450. Now let's look on to the right-hand side. Let's look and assume that instead of doing $100,000 per year, they take their 2 years and they bunch it into 2025. So again, they get that $10,000 state and local tax. 2025, they'll claim $200,000 in charitable contributions. No AGI floor in 2025, so they'll get the full deduction value. And then they will get a benefit of 37% on that $210,000. So $77,700 is the benefit on that. 2026, we're not giving to charity. So they get the standard deduction, the high standard deduction, which is $32,200. One of the caveats with this value cap, this 35% value cap, it doesn't apply to those that claim the standard deduction, only itemized deductions. So they will get a 37% value on that standard deduction. So that equates to about $12,000. So total value in this second scenario is $89,614. So $12,000 in additional benefit just by bunching their donations into 2025 versus spreading them out over the 2 years. Now, this is easiest facilitated by like a donor advised fund. So contributing to a donor advised fund, you can contribute to the fund, get the deduction up front, and then ultimately the dollars in that fund don't need to get dispersed to the charities until a later time. So that's a great way to really take advantage of the laws we have in place right now and still meet your charitable giving goals in the long run. All right, so I'm sure a lot of people or most people have at least heard of a Roth conversion or familiar with it. But just for those that maybe are not quite as familiar, a Roth conversion is where you are withdrawing funds from a traditional IRA and redepositing those into a Roth IRA. Now, this can be done via trustee to trustee transfer. That's the ideal route. It's clean. You don't have to worry about certain tax reporting. You can also do a 60-day rollover where you actually take possession of the funds and redeposit it within 60 days. That does require an additional layer of tax reporting, and you are tied to a 60-day turnaround time. So if you didn't get them in within 60 days, it would be a taxable distribution to you. So really, trustee to trustee is going to be the ideal route here. It can be transferred in cash or in kind. So you can transfer the investments themselves. And then you can actually also convert directly from a traditional 401k or 403b plan to a Roth designated account or a Roth IRA. So these are all going to be considered Roth conversions. We usually find people do these towards year end, primarily because year-end is when we kind of have a better handle of on our income tax situation. So earlier in the year, it's a little difficult to quantify exactly what our income is going to be. A lot of times people like to do Roth conversions within a certain tax bracket before it, causes other issues to arise. So year-end is a lot of times the time of year where we really look into that strategy. Now, with a Roth conversion, you are converting any dollars in the IRA, any deductible contributions and the earnings in the account are going to be taxable in the year conversion. The benefit is the dollars in that Roth IRA that once you convert are going to start growing tax-free. They're not going to be subject to RMDs, which is great. And it's going to be taxable as ordinary income when you do that conversion. One thing to keep in mind is with Roth conversions, you're no longer able to recharacterize them. So I think it was prior to 2018, you could recharacterize Roth conversions. So you could do a conversion and the market could drop and you say, actually I want to put it back. You could recharacterize it then. That's no longer allowed. So once you do a conversion, it stays a conversion. No takebacks there. And the other thing to keep in mind with conversions is that it can have additional impacts other than just your marginal tax costs. That was kind of indicative as we saw that chart I showed with all the different phase outs and things coming into play. So, we want to consider the impact a Roth conversion has on other items such as IRMA, so that the Medicare premium amount, losing a senior deduction or the SALT deduction could cause you to be subject to net investment income tax. So a lot of different moving parts with the Roth conversion. But with a Roth conversion, it is a great planning tool. There are 3 things we like to consider when deciding if a Roth conversion even makes sense for an individual. So first is going to be, how are you going to pay the conversion tax? So it's hard to justify using the IRA to pay the tax because you're basically reducing the amount of dollars that are going into that Roth IRA and generating tax-free dollars. Now, this is especially true if the taxpayer is under 59 and a half, and that's because of the 10% early withdrawal penalty. So if you're under 59 and a half and you use the IRA to cover the tax implications, not only are those withholding amounts going to be taxable to you, but it's going to be hit with a 10% penalty as well. So we ideally want to pay the conversion tax with outside dollars, such as assets in a taxable account or a savings account or something like that. The next piece we look at is our current versus our future tax rate. So it is best to convert in a year where your marginal tax rate is lower than what your projected rate is going to be when taking IRA withdrawals. So usually your RMD age. So we a lot of times look at years when your income is lower. We a lot of times call that the trough years. So years post-retirement, pre-Social Security RMD age, your income is lower, you usually have an opportunity to maybe fill up some of those lower tax brackets. And then the last piece is, when do you plan to withdraw from that Roth account? So the longer the Roth has time to grow, the more effective that conversion is going to be. It needs time to grow tax-free to make up for accelerating that tax cost in the current year. Now, this is ideal for excess IRA money that you're not going to ultimately need in retirement. So it's a great tax-free, it builds a tax-free bucket, but it's a great wealth transfer planning tool. It provides a tax-free bucket for your heirs. So it's going to grow through your lifetime, and then it'll actually have, in most cases, another 10 years post your death to grow tax-free, at which point your heirs will need to withdraw. All right. So, when it comes to year-end planning, there's a few considerations or key points we always want to highlight and just remind our clients on. So tax payments is a big one. When it comes to tax payments, the IRS wants you to pay in a certain amount throughout the year. Otherwise, they're going to assess you an underpayment of estimated tax penalty. So there's 2 ways generally you can avoid this penalty. You can either pay in 90% of your current year tax liability. So that would be 90% of 2025's tax. That's tricky to know unless you have a tax projection done, and you have a good idea of what your income is going to be and deductions are going to be for the year. So the other option and the easier one to quantify is going to be 100% of your prior year tax liability. So 2024 amount. That percentage actually jumps to 110% if your prior year AGI was over 150,000. But this is the metric we often use because it's just the easier one to quantify to ultimately determine what amount we need to hit throughout the year. Now, generally, the IRS does say this needs to be paid evenly throughout the year. So that's 25% per quarter. But you can choose what's called an annualized income method. This is a special form. It's a Form 2210 on your tax return. And that can be used when income is backloaded in the year. So this kind of feeds right into those Roth conversions, which a lot of times people are doing towards year end. Technically, if you use the annualized income method and fill out this extra form on your tax return, you can let the IRS know that, hey, I did this Roth conversion, I have this significant amount of income, but this didn't happen until Q4, so I don't need to pay an estimate until Q4. So this is just another method that you can use to pay your taxes in the respective quarter, but also by still meeting that safe harbor amount, avoiding penalties for the year. Now, when it comes to estimated tax payments and withholding, we want to just make sure we have enough liquidity to cover any remaining tax liability in April. So I talk about these safe harbors. That is what you need to hit to avoid the penalty itself. But you do still need to pay any balance due in April when tax time comes. There are extension, you can file an extension, but that's an extension to file. It's not an extension to pay. So just make sure you do have enough liquidity come April. And then for state tax purposes, that varies by state. They have different safe harbor thresholds. A lot of them do follow federal 90 and 100%, but some have various thresholds. So you want to check with your resident state. Now, when it comes to making tax payments, the basic ways are going to be as follows. So applying your prior year tax refund to the next year, that's done on your tax return. So you would actually, if you had an overpayment, you could say, hey, instead of getting a refund, I want to apply this to the next year. Withholding from your W-2, withholding from your IRA or other investment distributions. And then the last is the quarterly estimated tax payment. So that's where you were writing a lot of times writing a check and sending in it with a payment voucher. The IRS did, there was recently an executive order that's basically saying as soon as practical, payments to the IRS has to be made electronically. As of today, the IRS does still accept paper checks, but they do strongly encourage you make electronic payment methods. We don't know when they're going to actually stop accepting paper checks, but something to keep in mind, you want to probably get comfortable with making electronic payments if you don't do that already. There are 3 methods you can do. You can do IRS Direct Pay. That's what I personally do. It's very easy. IRS online account, you can create an account on the IRS website and use an ID.me account. And you can maintain your payments. You can track all activity with your return on there. That's a great tool. And then the last is going to be a debit or credit card, but that does come with some additional fees. So you just want to make sure that you are hitting your required payment amounts through the year, however way you do that, withholding estimated tax payments. And then we also just want to make sure we're aware of our deadlines. So 12/31 of this year, that's the deadline to take a 2025 RMD if you turned 73 in last year or earlier. It's also going to be the deadline if you inherited an IRA in 2020 through 2024. So assuming the decedent had reached their required beginning date, this was postponed. I'm sure you've heard if you inherited an IRA under Secure 2.0, this was postponed year over year just because a lot of the rules hadn't been finalized or clearly articulated. So they kept delaying when those payments needed to be made. Those are no longer delayed. So 2025 does require an RMD if you did inherit an IRA in these years. Employee contributions to employer-sponsored retirement plans. So specifically if you're doing like salary deferrals, those have to be done by year end. Same with charitable contributions. If you want a credit and get the deduction for that charitable contribution, they do need to be made by December 31st. January 15th is going to be the fourth quarter due date, fourth quarter federal estimated tax payment due date. So if you had activity like a Roth conversion done in Q4, that's the deadline to make that quarterly payment. April 1st of 2026 is the deadline for 2025 RMDs if you turn 73 this year. So your first year when you turn 73, you technically have until April 1st the following year to take that first RMD. But keep in mind that if you do that, you will have to take 2 years worth of RMDs next year. So let's say I turn to 73 this year. I decide to wait and take my RMD for it next year. I'm going to have my 2025 RMD as well as my 2026 RMD that must be taken next year. So 2 years worth, and that's going to hit my tax return. And then, of course, April 15th, 2026 is tax day. So that's the deadline to contribute to traditional IRAs, Roth IRAs, and HSAs for 2025. Also, the deadline to file your 2025 tax return or your extension. Like I said previously, that payment is still due. Even if you file an extension, that's just an extension to file, not an extension to pay. So that kind of covers everything we wanted to touch on. A lot has changed this year, especially with the new bill that's passed. So, a lot of our general planning strategies that we've looked at every single year still apply, but there are some curveballs, I'd say, this year, just considering the new deductions that are coming into play, as well as the new limitations that are arising starting in 2026. So a lot of opportunity here. I do think we do have some time, it looks like, to answer some questions. I don't know, Colin, if you wanted to wrap up and I can kind of take a look and see which ones might be worth.
Yeah, absolutely. So, thank you, Kelsey and Eric, for sharing your insights with us today. We've seen some great engagement from the audience. Audience, as a quick reminder, if you do have a question you'd like to ask, please use the Q&A icon located at the bottom right of your screen when submitting your question, and you can address it to all panelists to ensure that it's properly routed. So I will let you and Eric take it away.
Awesome. Okay. Let's see some of the questions that I'm seeing here. So, what types of taxes count towards the $40,000 SALT deduction, the new SALT deduction? So the taxes that are going to apply here is going to be your state and local income taxes. So generally the taxes that you're paying towards your state tax return, local tax returns if you're filing them, any real estate taxes you're paying on your home, property taxes, so on your personal vehicles. But keep in mind that with all of these taxes you're paying, they have to actually be paid in this year, so by 12/31. So that's going to be withholding. If you had withholding on like a pay stub, that's all going to count. But if you, let's say you live in a state where your fourth quarter payment's not due until January 15th, if you don't make that payment until January, then that doesn't count towards this year's state and local tax deduction. So it is only going to apply to those taxes that are actually paid this year by 12/31.
Kelsey, we had a question earlier on Roth IRAs and RMDs. So maybe we can just make sure one of the benefits of having a Roth or converting to a Roth is that the distributions are tax-free as opposed to tax deferred, which is what a traditional IRA encounters. So we love Roths. We want to make sure people understand how much it costs to convert to a Roth. With that being said, there are two little 5-year rules that in order to get a completely tax-free distribution from a Roth, you have to meet. And that's, you have to have the Roth IRA open for 5 years. Not so much the Baird Roth IRA, but you have to have a Roth IRA. And maybe you had one 20 years ago. That would count for your 5-year window. But you need to have had a Roth IRA open for 5 years and be 59 and a half. And all the distributions will be entirely tax-free. So if you've never had a Roth, we recommend you open one. And if you make too much money to contribute or don't have earned income to contribute, you can still do a conversion. So talk to your advisor about the lovely benefits of having a Roth. It just gives you that third bucket of money that you can choose from later. You'll have your traditional taxable money to live off of, traditional IRA money, and Roth money. So Roths are great. They don't have RMDs, and it's tax-free as opposed to tax-deferred.
Awesome. I also see another question that said, can you clarify the comment about ordinary income as the starting point for capital gains? So when it comes to, if you have long-term capital gains, qualified dividends, those get stacked on top of your ordinary income. Your ordinary income is going to be your wages, non-qualified dividends, interest, pension, IRA distribution, Social Security. So you need to basically determine what your ordinary taxable income is first. And based on what that dollar value is, that's when you look at your capital gains brackets to determine, okay, where does my first dollar of long-term capital gains get taxed? So let's just say that you're a single filer, you have ordinary taxable income of about 60,000. That means your first dollar of long-term capital gains is going to be taxed at a 15% bracket, because on the single scale, I think the 15% bracket comes into play at about $48,000. So since 60 is above 48, that first dollar is going to be taxed at 15%. I also see one, can I only claim the $6,000 senior deduction if I itemize my deduction? So the $6,000 senior deduction applies no matter what. So it's kind of a benefit on top of whatever other deductions you're claiming. So even if you claim the standard deduction, if you itemize your deductions, as long as your income is below 150,000, you can still claim the $6,000 deduction if you're age 65 and up. I also saw another question earlier, and I'll kind of jump into that here, because the question was about didn't the bill eliminate taxes on Social Security? This was kind of their way of addressing that. I put that in quotations, addressing that. There was no elimination of tax on Social Security benefits. This was their way of saying, okay, we're going to give you a $6,000 deduction if you're 65 and up. But hey, it only applies to those under $150,000 of income. So this was their way of kind of addressing that. But of course, it does not fully address the taxation of your Social Security benefits.
We have a question, Kelsey, that the client wrote in that he and his wife give to multiple charities. They would like to clarify that the 0.5% of adjusted gross income reduction is from total annual charitable giving and not per each charity. So good question. Let me see if I can clarify. So you would take your adjusted gross income multiplied by 0.5. So let's use 100,000 for easy math. 0.5% of 100,000 is 500. So 500 is the reduction amount for all your charitable contribution. So it's not calculated on a charitable by charitable item. You add up all your charitable giving. If that's 3,000 and the $500 the floor, then your deductible amount in total on your 1040 would be 2,500. So you don't have to worry about figuring it for each charity. You do it on the total and as a percent of your adjusted gross income.
Okay, let's see. When do you need to pay 110% of the prior year's tax liability? So the government wants you to pay as you earn. So that's most easily accomplished through withholding. So, as you are getting payments, you have withholding taken out. The IRS is going to assume that withholding is done evenly throughout the year. So even if you withhold in December, they'll assume 25% was done in Q1, Q2, Q3, and Q4. Now, when you should pay that in, by default, it's going to be 25% per quarter. But in instances where your income fluctuates throughout the year, so like our example where we did a Roth conversion, but we didn't do it until Q4, you can use a different methodology where you can complete a form on your tax return and tell them that you didn't generate this income until Q4, and therefore you didn't make a payment until Q4, which is January 15th. So like I said, withholding's the easiest because they automatically assume it's done evenly throughout the year. But if that's not an option or you don't have methods to withhold, doing a estimated tax payment is an option. But with an estimated tax payment, it is tied to a date. So ideally, you're paying those in the right order. You're doing them per quarter, unless, of course, you didn't generate income until a later time in the year, where you can fill out this form and basically tell them, hey, I don't need to pay this yet because I didn't generate the income yet.
There's a question from a client that said he's 68, filing joint, they itemize, and they're interested in Roth conversions. What tax bracket would you recommend to go up to or stay under, 32 or 37%, et cetera? That's kind of a personal question, I think, from the standpoint of it depends what you're going to do with your IRA. Do you need the money? Is it beyond, if you have enough taxable money and retirement money and other money to live off, and you may never need that Roth, that can affect that decision. Also, where's that Roth going to go? Is it going to go to your spouse? Is it going to go to your kids? Because some people don't mind paying the tax on the Roth conversion when they're in higher brackets, 32, 37%, because they're effectively taking money out of their estate, paying it to the federal government for the Roth conversion. But they know that their children, who may be the beneficiaries of the Roth, are going to be inheriting a Roth IRA. The only side issue there is that Congress here 3-4 years ago said we need to make all IRAs, other than a spouse beneficiary, they have a new 10-year rule. So with traditional IRAs, you have to take money out of a traditional IRA now, a required minimum. For Roth IRAs, you don't, but you have to empty the Roth account in 10 years, but still your children would be inheriting a Roth IRA. So if you don't mind paying the tax for others, we see people converting at higher ordinary brackets. So there's no right or wrong answer there. It's just a function of what you're trying to accomplish, where you think you want your Roth to go, and how you feel about paying taxes.
I also see a question. This is more towards business, but how many years does the bonus depreciation 100% continue? Basically, bonus depreciation was phasing out by 20% each year. I think it was scheduled to be fully phased out by the end of 26. That has now been reinstated to 100% bonus depreciation, and it has technically been made permanent. Permanent doesn't only mean so much in taxes. It can ultimately be changed at any point, but based on the law, it has been made permanent. And for those, this is really just for those that own a business or have a business purpose, and they're purchasing equipment or assets and depreciating it. There's a special provision where you can expense it 100% in the year it's placed in service. So that's what we're referring to here.
There's a question on QCDs, and please explain how QCD reduces modified adjusted gross income, and can a QCD of 10,000 and a Roth conversion of 10,000 cancel out of the ordinary income for the 10,000 Roth? So let me clarify. The QCD, the great thing about it is if you take money out of a traditional IRA, it gets added to your 1040 as ordinary income. If you designate it properly with Baird and say, I want that 10,000 to go to a qualified charity, Baird will have it sent to that qualified charity. And that $10,000 basically just doesn't get counted as ordinary income. So it's like it was not an income item at all. It came out of your IRA. It can satisfy the required minimum distribution, but it doesn't count as income at all. If you turn around and do a Roth conversion, that's still 10,000 of additional income. So the QCD doesn't reduce modified adjusted gross income. If you take money out of your IRA, put it in your pocket, that's 10,000 of income. So doing a QCD would be different than that, but the QCD itself does not reduce modified adjusted gross income. It just doesn't show up on your 1040 at all as income.
See if I see any more. What is the form for the annualized income method? That's what I was talking about, to potentially pay an estimated tax payments at a later time if if your income was generated later in the year. That form is Form 2210. So if you have a CPA, they should know what that is. And a lot of times they'll do that automatically if they know, you have an underpayment of estimated tax penalty and they have a way to mitigate that. If you're self-preparing like TurboTax, there should be a screen somewhere in there that asks this question about annualizing.
There's a question on, we have earned income through our business, which results at a loss of the year, I think through depreciation. Depreciation is generating the loss effectively. Since we had earned income, are we eligible to contribute to an IRA? Well, kind of depends. If you report that business on a Schedule C, sole proprietor form on your 1040, you need to have positive earned income at the bottom, line 30, I believe. So if your depreciation is generating, is basically putting that business into a loss position, then technically you don't have earned income eligible to make a IRA contribution, but that's a Schedule C. If your business is on a 1120S, if you're an S corporation, if you pay yourself a wage, then you would have earned income. And if you had depreciation on there and that pass-through income was negative, you could still contribute it to an IRA if that W-2 showed you had sufficient income. So it kind of depends upon whether you're a Schedule C, which with a tax loss, you wouldn't be able to contribute to a retirement plan. If you're an S Corp, you probably could if you had enough W-2 income. So it kind of depends on the business formation. We're happy to talk to you about that though.
All right, so I see a question. Do beneficiaries still get the step-up basis when inheriting assets from parents' estate? Should that be considered for Roth conversion decisions? So yes, as long as the asset was in the parents' estate, is included in their taxable estate, then yes, the kids or beneficiaries would get a step up in basis on those assets. IRAs, however, are not inclusive in that. There is no step up in basis with inherited IRA accounts. So a Roth conversion isn't going to impact a step up in basis. A Roth conversion is great as a wealth transfer planning tool because you are paying the tax now on those pre-tax dollars, getting it into a Roth. It'll grow tax-free. And then when they inherit it, they will also pull it tax-free. So there is no basis step-up considerations with IRAs because it's either a tax-deferred or tax-free asset.
Quick question on what is your sense on a national basis of what percent of Americans still itemize? I believe, Kelsey, I have seen some IRS data that it's low 80s of people that take the standard deduction now. And I think it was 40, 50% in the past because the standard deduction was so much lower and we didn't have that funny SALT $10,000 cap. So a lot of people were eligible to itemize, but when you increase the standard deduction so much and you kneecap people with the $10,000 state and local cap, it just, the math doesn't work. People's standard deduction is greater than their 4 itemized. And I think I saw that was in the low 80s of people who now take the standard deduction. So I think it's gone in the direction that Congress and IRS wanted, but a lot of people just don't itemize anymore.
All right, and so it looks like we're actually coming up on time. Thank you again, Kelsey and Eric, for your contributions. It was awesome to hear you answer all those questions so expertly. And thank you to everyone who joined us today. We hope you found the discussion valuable and a worthwhile use of your time. If we weren't able to get to your question, or if you'd like additional information, please don't hesitate to reach out to your Baird contact who can connect you with the appropriate resources. For those interested in revisiting today's presentation or sharing it with others, whether a friend or family member or colleague, this session has been recorded and will be available in approximately 1 week. You can access it through your Baird financial advisor or by visiting bairdwealth.com. If you're not currently working with a Baird advisor and would like to explore that opportunity, you can find an advisor near you by clicking the Find a Financial Advisor button on our website. A direct link will also be included in our post-event survey. Thank you again for joining us, and we wish you a wonderful rest of your afternoon and weekend. Thank you so much.